there, welcome to the Global View on this Friday morning. Let's just check in on markets and where we're expecting to see SPY futures open. Pretty painful session after what we saw on Wall Street through the overnight period. And a lot of that was risk appetite being damaged by the Federal Reserve's monetary policy. You know, will it remain restrictive for longer? That's what the dot plots say. All of it is dependent on the data, and the data was pretty mixed. So we saw sales of pre-owned U.S. homes unexpectedly dip. That's to be expected. 30-year fixed mortgage rate up around 7% since early August. But in contrast, jobless claims dropped by 9%, much lower than expected. So that shows continuing strength in the labor market. We saw softness in the Conference Board leading index. It's now fallen for nearly a year and a half straight. We just heard from a guest who said that always indicates recession. Now, in other news, the Bank of England, of course, halted its interest rate rises. It was a tough call, 5-4, to keep rates at 5.25%. But Governor Andrew Bailey says there is no room for complacency on inflation. 10-year Treasury yields surged to just shy of 4.5%. Bond ETFs are at multi-year lows. So to get a view as to whether recession is imminent, if so, what will it look like? I spoke with Tony Crescenzi from Pimco, who gave me his thoughts on the FOMC to start.
Well, of course, the common phrase about the Fed is it's in the midst of a hawkish pause, and we would agree, a hawkish pause, meaning that it wants to leave its options open, just as other central banks seem to be doing. You saw the Bank of England this week do the same, meaning pause, and then seem to indicate that they may do more. The last thing that central banks want to do is unleash the torrent of financial markets to ease policy just when the central banks want to keep policy tight. And this idea of keeping rates higher for longer is something that was evident in the Fed's so-called summary of economic projections, is a way of making policy tighter in 2024 than many had previously expected. Because history has shown a key lesson is to keep at it, to use the phrase that Paul Volcker, the legendary Fed chair, used in the late 1970s, early 1980s, to conquer inflation. You got to keep at it until the job is done. And so what the Fed did in its projections, a summary of economic projections, is indicate that it thinks the real interest rate, and I'll describe that in a second, will be higher than it previously thought, which is a different way of saying it wants to tighten the screws for longer to ensure that the path to disinflation continues. And by the real interest rate, I mean where the Fed keeps its policy rates, expected to be at 5.5, according to the Fed. Subtract the expected inflation rate, which is about 2.5, about 3, according to the Fed, and you get a 2.5% real interest rate. That's about a half point higher than the Fed previously projected, which is to say the Fed wants policy to be tighter. Let me give you a quick thing to say about this. As the funds rate is held steady at 5.5, which is what the Fed projects, the inflation rate may decline. And of course, that's what the Fed is projecting. But because the Fed would be keeping its policy rate higher and not move it, policy gets tighter. That's simply the way it works. So the higher the real interest rate goes, the tighter policy gets, and the more that it ensures a good outcome, which is disinflation.
Disinflation. Okay, but does the Fed need to crash the economy, as one fixed income specialist alluded to yesterday in conversation with me? Does it need to crash the economy to get that ultimate goal?
Not necessarily, Nadine. And the phrase that you quoted from me, this idea of a growth recession, is the reason for that. Now, a growth recession is where the economic growth rate is above zero, but below an economy's ability to grow, which is called growth potential. And in the United States, that's 1.8%. Why is it 1.8%? Because there's a certain amount of growth in the numbers of people that can work, and it's about 0.3% per year in the United States. And there's a certain amount by which people are more productive. It tends to be 1.5%. So we have them two together, it's 1.8. But what if the economy grows at less than that rate, 1.8%? Let's say under 1%, which is what Pimco projects for next year. Then clearly supply can catch up to demand, and there can be disinflation without crashing the economy. Now, if the inflation rate were to continue to accelerate, then the Fed may have to take more stringent actions to ensure that the growth rate gets back below potential so that supply can keep catching up to demand. and ensure that path to disinflation. So it doesn't look like it's needed now because all the boxes are being checked with respect to a rebalancing of the economy, the labor market, for example, supply chains, the availability of credit, everything's moving on a path to disinflation, which, by the way, for bond investors in 2024 should be quite good news because disinflation is what's wanted, needed to produce better returns in the bond market, and that's what we expect for 2024.
Okay. So you're saying we're going through this period of pain for bond investors to hit some clearer skies come 2024. So what does 2024 look like then, and where might the opportunities lie?
Well, Nadine, history suggests that bond investors should be considering moving out on the yield curve the closer the Fed gets to the end of its rate hike cycle. It's difficult to say the amount of months, but on average, it's just a few months. And so it may be that the Fed is done, or at least it's probably near done. And by moving out the curve, I mean, and for Pimco, we'd say the sweet spot for the curve, the yield curve, is the 5 to 7 year maturities. Now, consider, for example, if an investor stays in T bills over the next few years, somewhere over those next few years, there probably, in our judgment, will be a rally in bond prices, reflecting a decline in interest rates related to eventual interest rate cuts. And so, in a 5, 6, 7 year maturity, you'd be looking at 4, 5, 6% gains in a situation where yields decline by 100 basis points, which is certainly plausible out there in the future. So that's a gain that you could tack on to the current yield to make a projection about where your return will be, and it will be most likely higher than where the T-bill yield is. And one quick stat: since 1978, the core fixed income, called 5, 6, 7 year maturities, has outpaced returns on cash 90% of the time by an average of 3 percentage points over a 3 year rolling period. And so you don't want to catch a flying knife. I understand that, but you may want to catch it while you can and grab these yields, own them, rather than rent the short term yield that you could get on T bills.
So that's strategy. Thank you for that. What could derail your view about this growth recession being good for bond investors come 2024 in particular? We've got rising geopolitics. We still do have unknowns around central banks, but I'd like to move away from that just briefly. We still have war in Europe. We've got a lot still to contend with outside of just purely central banks. We still have fiscal policy that is hugely accommodative. So when you think of the biggest risks, what could upset the apple cart, Tony? What do you worry about?
Well, it's great that you bring fiscal up into the discussion, Nadine, because that is one potential disruptor in the future for bond investors. More likely a 2025, 2026, or even later story, but the date is approaching. The date that I worry about most personally is this idea of what I call a read my lips moment from President George Bush on the campaign trail, 1988. Said, read my lips, there'll be no new taxes. But guess what? The fiscal story worsened, and interest on as a percent of GDP in the United States rose to a record 3.2% that stands to this day. But guess what? From that, relative to that, in the next few years, the figure will breach 3.2% again, and the policymakers will face tough choices that will affect bond investors. But I would offer to you, Nadine, that the bond investor will take a leap of faith that ultimately the fiscal problem might improve, and they'll defer their judgment till after the 2024 election. So in the meantime, there's probably nothing to do with respect to portfolio adjustments on this fiscal story, but you'll want to watch it very closely. So that's the key issues that could derail the picture, and of course, the resilient economy that requires more rate cuts. So one quick point about that. Let's say the Fed does need to do more. Consider it, though, as tough love or medicine for a sick patient. You want to see the Fed do more if there's an inflation problem. Doing less would be the bigger problem because of the letting inflation set in more deeply, something that Chair Powell said this week, would be certainly a big problem, more difficult to get rid of the inflation problem at that point.
So that was Crescenzi from Pimco. Look, Bank of England left its interest rate hike unchanged. Surprised me, surprised markets. Let's get a view from Fiona Kinchata, who's senior market analyst from City Index. She was joining us from London.
There has been a lot of choppiness as we've been approaching this meeting. So if we think back just to the start of this week, the market was pricing in that 90% probability of a 25 basis point rate hike. Then we had that unexpected cooling in inflation, and that sort of changed the expectations for the Bank of England. And it was very much considered to be a decision which was going to be the closest decision for a very long time from the central bank, and that it was. I was actually expecting the the Bank of England to fall the other side and err on the side of caution as far as inflation is concerned, which is still 3 times the central bank's target level. But no, the vote split was actually 5-4 in favour of leaving rates unchanged at that 5.25%. Now, the pound sort of fell off quite sharply on the back of that. We've seen a deterioration in the sell-off in the pound really since the start of, the end of July. We've seen this sort of, weakening and sterling down from over that 130 level that it was. And we've seen it test some really key levels. It's broken through the 20 SMA, and we're seeing it sort of test that 123 level at the moment. So I think if we do see a fall below there, or a meaningful close below there, then that does open the door to the 120 level. But I think also, as far as the meeting is concerned, there's this big question of what does this mean that the Bank of England's now looking at? Because as I said, inflation is still high, it is cooling, but maybe we're getting this idea that the Bank of England is more concerned now about a potential recession in the second half of the year than they are about inflation. And I think that may be what caused this turning, this change from the central bank. And I think we're going to get more clues about that tomorrow in the PMI data.
Well, right, because it is data dependent. The governor said that there was no room for complacency. So that also was taken by the markets as, again, this reaffirmation of the higher for longer mantra that we're getting really in many parts of the globe, including with the Fed, of course, the previous session. So what do you need to see in the data to confirm that this was, quote unquote, the right move made by the BOE?
Okay, so I think what we've got before the next central bank meeting, the next Bank of England meeting, which is in November, we've got another inflation print, and we've also got some more employment data through. Now, it's interesting because as far as the economic growth is concerned, we have seen mounting evidence that the UK economy is slowing quite considerably. GDP data come in weaker than expected. It contracted by 0.5% in July. We also seen unemployment risen to its highest level since 2021, and PMI data is continuing to show contraction. So I think, if we see this trend continue in those data points, particularly in the PMI and the unemployment data, then that's going to confirm those concerns about recession. The other ones that I'm going to be watching, obviously inflation, to see that is still cooling, but also the wage growth. We've had record wage growth here in the UK for the past few months now, and that's going to be something that the Bank of England are going to be wanting to keep a close eye on. Obviously, high wage growth is going to be creating inflationary pressures, and that doesn't really bode well for the fight against inflation. So I think between now and November, we're going to be looking for more contraction in PMI data, higher unemployment. And I think if we start to see those, then there could be a sense then that the Bank of England may just keep rates on pause again.
Yeah, but Fiona, you're not trying to nut out a timeline right now for cuts coming through, are you?
No, I think that's just such a long way off from where we are right now. I think, even as far as the UK economy, which does look the outlook for the economy is really, I think, pretty bleak over the second part of this year. I think, the prospect of any rate cuts from the Bank of England is not going to be well into 2024, easily at the end of Q2, if not early Q3, if I had to put a timeline on it.
So for the traders out there, Fiona, are you expecting to see a lot of volatility in FX markets, in the coming weeks, months, as these central bankers settle upon a course to keep inflation under control, because they all say that's public enemy number one still, and help negotiate this soft landing?
A really interesting second part of the year. So, the currencies which have perhaps outperformed in the first part of the year, I think are going to be the currencies that are perhaps going to underperform in the second part of the year. We'll be looking at further weakness in sterling. I think there's a potential for further weakness in the euro as well. And the dollar rally that we've seen, the dollar's approaching this really interesting moment. We're sort of pressing on for 10 straight weekly gains in the dollar index, which, is not something we've seen in over a decade. And it's approaching that 105.80 level, which is going to be absolutely key. The way that we see the price respond to that level will really dictate where the dollar is going to be going for the rest of the year, for the second part of the year. And I think, but looking ahead, yes, there's going to be volatility. And I think the reason that we're going to be seeing that volatility is because we know that the central banks are going to be really data dependent. And so that means that each data release that we're seeing, particularly around those important points such as the labour market, inflation, PMIs, are going to be watched really closely by the central banks and therefore by the FX markets.
Stick around. We'll bring you through the open of trade next. We've got the local market coming under pressure very early in the session. Let's give it a moment to just digest, to see how that's being reflected in some of those major sectors. But so far this week, folks, pretty dismal. We're down by 3.3%. Back in a moment.